And welcome to Breakfast Club. John Hutchinson with Traders Reserve. Now that I'm done with my practice session, let's go to the live version and take you right to our agenda. I want to talk today about the three most important words, factors affecting the markets, why I didn't hit the panic button last week, especially in the momentum portfolio in AI2 Insiders, the enthusiasm gap. What's really happening in artificial intelligence? A little more data. I'll give you another three words that I'm asking myself every weekend as it relates to artificial intelligence to make sure that I stay on the right side of things. And we'll talk a little bit about why the negative sentiment in artificial intelligence is really overdone. Uh, it's a little frustrating to hear um, the constant drumbeat of either bubble or uh, the things of that nature. Anyway, keeping it simple, because there's a lot of cool stuff happening in artificial intelligence that the media should be talking about, but they're not. But again, negative sells advertising, and that's what they're there for. So there you go. And a simple exercise you can do. I'll share that with you as we get to the back end of today's presentation. The three words, the most important three words: raised forward guidance. These are I can't stress uh, the frequency with which I've seen that statement occurring from earnings reports in the last 2 to 3 weeks. Just last week, four stocks that we had followed either in our current AI2 momentum portfolio or from the September portfolio that we gave folks had substantial moves post earnings because they raised forward guidance. So not only did they beat on EPS, beat on revenue, but they raised their forward guidance, and that caused people to pile in. The challenge as an investor, as a trader, is to be cautious about not chasing that performance, uh, waiting for those stocks to settle, create a new base, create new trading ranges, either a support resistance range, and then look to add them. If these companies are proving themselves now by beating earnings, by increasing forward guidance, we have time. We don't want to suffer the fear of missing out just because one stock happened to move, oh, I don't know, 34% in one day. But last week alone, Coherent with a 16% move post earnings. Lumentum, which we just closed today, made a 22% move post earnings. Red Violet, which was in the September portfolio with a 9% move. JFrog, also in that September portfolio with a 27% move. And topping all of them was a company that I've talked about multiple times in the last 2 months, Lemonade. Yeah, insurance. I know insurance is boring. That's a 34% post earnings move in one day. And if you look down in the very bottom right hand corner down here, you can see volume to match, right? That is a massive spike in volume. That's institutional. That's not retail. Retail investors aren't following Lemonade. So now we're establishing out a new range here, and we've got a new range on Lemonade, somewhere between 70 and 80. So we'll see if it settles in this range. I think it was up a little bit today. Um, might look to add this stock at some point in the near term, especially in our momentum portfolio. And even here, there were signs channeling up from 50 to 60. So, but in the earnings transcript was this question and answer with the CEO of Lemonade. Where would you rate yourself on a scale of 1 to 10 in terms of using AI tools, et cetera? And right now, they're using it extensively across operations, but this was the biggest thing. We're just getting started. So one of the things that I keep repeating is how early we are in the artificial intelligence transformation. And I'm seeing these types of statements from CEOs confirming that all of what's happening in artificial intelligence requires patience that Wall Street appears not to have. and that's understandable. It's going to happen. But a month ago, when we canceled a buy order for AI2 insiders, we canceled the buy order on Penguin Solutions, and I shared with you afterward one of the quotes from the CEO in his earnings call, and how he said, we're still in the early stages of this transformation from a technology holding company to an artificial intelligence centric business, right? So everything is early stage, but there, the profitability of these companies already exists, and that gives me more um, that gives me more expectations for being able to outperform in the next 12 to 24 months in this space. So I'm excited with what's happening right now. But as I said, the negativity in the media is irritating. And I'll be honest, it's probably just a pet peeve. Maybe it's just me. I'm not at the level of like sports fan throws things at television set yet, but I'm probably not far away. Uh, so that being said, all of that being said, last week was brought to a head a number of factors that have been affecting the market. Chief among them, in the very very short term, was the shutdown, uh, largely not for government funding reasons, in a sense, um, but instead because of government data. And absent government data versus private market data, Wall Street doesn't have a solid floor to work from in developing forward expectations. Simple examples: monthly jobs report, weekly jobless claims, two critical factors right now that give Wall Street either confidence or no confidence in the direction of the labor market, which for the last 8 months has been driving much of the discussion around everything from rate cuts to economic health. So, absent Bureau of Labor Statistics or BLS data, Wall Street's flying a little blind and relying on private market data. Now, last week, the ADP jobs report was positive, which was a switch from the prior month, which was negative. But then the Challenger job cuts report came out with 153,000 layoffs. That report is notoriously volatile. It is not widely followed, but absent government data, right? Everyone drinks the sand because they've got nothing else. So if the shutdown ends later this week, then and government data starts to flow again, I think you'll see some of the recent volatility in the market abate a little bit, but instead be more focused on fundamentals and technicals and not missing data. Um, Fed expectations, still overall the economic data over the last few weeks, what data we can get that is typical, like the ISM services, ISM manufacturing reports, they were actually much better than expected in the forward-looking departments, meaning growth in business activity versus contraction. So generally, economic data is fine. Recession not on the horizon, but that increases the expectations for the Fed to continue cutting rates. And we'll see what happens in December. We already know what the Fed did in October, and what the Fed will say remains to be seen. The negativity over CapEx, capital expenditures, which we'll talk about a little bit later on in a different context, but this is one of those negative areas that the media keeps harping on. That's irritating to me. But it's the return on investment in capital expenditure. Okay, let's make sure we get this straight. Microsoft says they plan to invest $50 billion in the UK to develop artificial intelligence infrastructure. Well, one, they haven't invested $1 yet. They haven't built anything, so nothing's operating, so they can't possibly generate a return on investment from it in 1 week or 2 weeks. This is what I mean by there is a gap in the enthusiasm around artificial intelligence, which is disconnected from the reality of these investments. These investments being made by NVIDIA, Micron, Microsoft, Amazon, etc. They're not short-term investments. These are investments with very long-term horizons. And that should be a positive for us as investors. It means because that's a lot of CEOs to be that wrong about something over leveraging that many billions of dollars or hundreds of billions of dollars. So somebody ain't right. And I generally believe the media isn't. So we'll see how that turns out. But the last thing is individual investors are oscillating in the more bearish than bullish category. The table above is from the AAII, American Association of Individual Investors, another company that needs a better name, shorter. But you can see on the bullish side, kind of draw a line, average, over here somewhere. It's a little lower than their historical norm. Here was Fed week, so everybody got a little bullish going into Fed week and then reversed after Fed week. Some of that may be related to the government shutdown, some not. But what surprised me here was the 1 year bullish high, nearly 50%, was almost a year ago to the day today. So over the last 12 months, investors have been trending this way, not in here. And the most bearish was in April, which shouldn't be a surprise. And hopefully we stay there, right? Just if we stay roughly in these ranges, individual investors should do just fine. For AI2 insiders, I mentioned earlier, one of the reasons I didn't panic. I had some paper bag moments, but I didn't panic last week. Was especially on Friday, and this is 6 charts. All 6 charts are from stocks that were holding in the insiders service. I just couldn't fit all data on. I mean, you can kind of see I had to cut something off there. But Friday, hammer. Friday, hammer. 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 All of them, this was just a bullish candle. But all of these occurring off of key support lines, either 50 or 10 EMAs, or for this stock, this was off of a support resistance line, right? All of that huge reversal we saw on Friday, right? Remember, Friday was down and up, and if it was the NASDAQ, it was just short of positive. The S&P was just over the positive line. And the whole week was like that. Wednesday, Thursday, Friday, all 3 days were like that. Some days came up a little bit short in the rally, but others, but Friday basically made it all the way back. So I went into the weekend really initially thinking I'm going to have to change out a whole bunch of stocks because we went from 10% to 6%, right? We lost, that's not true. That's not correct. We lost about 2.5% for the week. That's not terrible. But what I didn't want to do was make a bad decision based on the emotion of the moment. And I've talked in the past about removing emotion from the equation. I have to do it myself sometimes. So looking at the charts gave me 2 things. One, it calmed me down saying there is still bullish momentum in the market. And number 2, my running theory was that we would have an up day today. Now, not a 2% on the NASDAQ up day, but a better than last Friday up day. And that turned out to be the case. So the lesson is sometimes the best thing to do is to step back, walk away, think through, why are you in this stock? Most of these have been, I mean, you can see the similarities in all of the downtrends. There, right? So there are similarities in these charts, which is telling me that there is a consistency in the market that can be followed and trusted. And if I am right on the stock, I don't have to make a decision today. Meaning, for some of these stocks in the portfolio, I can keep holding them. I don't have to bail. I don't have to rush to the exit unless the narrative behind the stock changes. Now, one company not pictured here, Shopify, is a company that I will probably need to exit in the next couple of days. It has not recovered from it had a similar move like this in the top middle, only it was a little lower. So I don't I don't have to rush to the exit. I can see if that stock can make it back just a little bit, and close it, even if I close it at a small loss. So my lesson here is take a larger look than just one stock and see if there are patterns across a multitude of stocks or within individual sectors, whether that sector is semiconductors or retail or energy or what have you. If you start to see these types of patterns developing, that tells you that there's broader market demand even on a down day. And that's what I walked away with when I started looking at the totality of charts and not just one or two individual stocks. That being said, I want to talk a little bit about artificial intelligence. Sorry, I blew past that one slide. Every weekend on Saturday morning, I now spend an hour from 7 to 8 a.m. to ask this one question about artificial intelligence. Am I wrong? And given everyone's the media, as I've talked too much about, the bubble talk, the over enthusiasm, the capex, money here, money there, etc. I keep coming back to this to make sure that I'm on the right path, that I have a solid thesis rooted in fundamental analysis and market or economic reality. So divorced from disreality. And the great fear that most people have is that we're just repeating history. We're repeating the 1994 to 1999 dot com crash. And while there are similarities between both of those periods, there are also substantial differences. And the more differences that I find in the artificial intelligence side of the ledger, the more certain I am of my thesis. And I keep going back to this because I want to be certain, and but I also want to keep playing devil's advocate, right? If I can make the arguments as the skeptic, then I can find the data that either proves it or disproves it, and then use it to my advantage as an investor, as a trader. So here are these are some of the the excitement points. We've certainly seen that the next exponential growth, we're not there yet. We're entering that phase, but we're just we're literally walking through the front door. My other analogy on this is just a little drawing, right? If this is a pencil, not a real pencil, but if that's a pencil, and then this is the Empire State Building, roughly, and here's King Kong, right? Airplane, right? If you want the airplanes up there. So right, the pencil is it represents where we are in what businesses know they can do with artificial intelligence, and the Empire State Building is what's possible and what's not yet known. So there's a knowledge gap that exists in artificial intelligence. If we refer back to the quote from the CEO of Lemonade, right? Yeah, they're deploying and using it structurally throughout their business, but they're still at the beginning stages of learning and discovering what artificial intelligence can do for their insurance driven or AI driven insurance company. Um, Sorry for the 3-year-old crayon drawings. Look, at least it's not on your kitchen wall. So be happy about that. But there are still early stage examples of similarities. 200 times forward earnings back in 1999 was unrealistic. Uh, Palantir and a few other companies are there, but most of the stocks that I have put into the index aren't anywhere close to that. You'll see an example, but we're nowhere near that. Nvidia has now gone from essentially nothing to $5 trillion in 4 years. That's unheard of. Whether it's sustainable or not is to be proven. But Apple was the first to break a trillion, wasn't it? And they have sustained that market capitalization, probably grown it too. But this is what I keep finding is this is the projected market 10 years from now. $3 trillion for artificial intelligence. I mean, we're like here. So this, if all this is half right, that's still $1.5 trillion. That is a substantial market. Um, this is the type of research I do to make sure that I'm validating my thesis, that I have a good reason to be working inside of this space of artificial intelligence stocks. And really, where we are is the biggest concern. This goes back to what I said earlier about CapEx expenditures, right? Tech giants, $560 billion invested over the last 2 years. Oh, but they've only generated $35 billion in AI related revenue. But these aren't 1 or 2 year investments. These are 10-year timeline investments. So that we as investors, if we have the patience to see what or how those investments can play out, then we will be better positioned than the people who just bail because they read a headline or they freak out. And the dogs are going nuts. It's the background, so if you can hear that, sorry about that. There are some legitimate concerns, and they do need to be addressed. One, I mentioned already this return on investment. Okay, but if that improves, if that metric starts improving or continues to improve over time, then it validates that investment, right? It's small now, but if it grows, then that investment was the correct path. And that again is not $560 billion invested by one company, it's by multiple companies. And so that's the one thing I keep coming back to is all of those people can't be wrong. Some of them could be wrong, but not all of them. And then an MIT study, pilot projects fail, 95% of them, and fail to yield meaningful results despite $40 billion invested. Okay, but we don't know what those pilot projects were. So there's a missing factor in there. Number two, a pilot project that fails. I mean, how many times did they fail just getting a rocket off the ground? Right. So there's a massive learning curve that has to take place inside of business. It is not dissimilar to the software expansion era of the early 1990s when everyone switched from typewriters to Microsoft Word, Excel, uh, Novell for networking, or WordPerfect. I forget the other spreadsheet program that was, all of the all of small business, major business had to relearn how to type, how to create spreadsheets, how to create databases. Microsoft Access, I'm forgetting Access, right? That all of that expansion took place from the late 1980s into the early 1990s and then grew from there. It's no different with artificial intelligence. There is a knowledge gap, which, in my opinion, would lead to the likelihood of pilot projects failing. But just because the pilot fails doesn't mean that people are going to give up. They have to go back, retest, restart, and do it again. But is the return on investment valid, and does it happen? And that's what we'll keep our eye on in months forward. But the biggest difference, again, still keep hearing too many similarities with the .com, and it doesn't make sense. AI companies are profitable. NVIDIA doesn't just sell AI chips. Microsoft doesn't just provide cloud infrastructure for artificial intelligence. Neither does Amazon, right? All of these companies are existing revenue plus AI. That's what is different and defining about this new era. Better valuations. When I look at most of the valuations, I'm generally seeing anywhere from 25 to 50 times forward earnings. That's substantially below what was happening during the .com era, where are there some stocks that are overvalued? Yes, absolutely. But if you don't have a pattern, a path to assess the valuation into the future, and I'm leading you into a slide that's coming up shortly, then you're operating on a data set that's too limited. You're making a decision based on something that's true now, but may not be true in a year or in 2 years or even 3 years from now. Market breadth. The other major issue here is, as we've posited, as our thesis goes, is artificial intelligence is a transformation of business first, right? Everybody's thinking in terms of the consumer, but we're not there yet because businesses are still in that knowledge gap, learning phase, adoption phase, uh, piloting phase, rollout phase, whatever you'd like to call it. So there's still a long ramp. And that ramp means that there are going to be some companies that are winners in artificial intelligence. There'll be some losers, but the more work we do to find out or to identify the companies that have the best place in their market, in their sector, in their industry, and the sooner that we can hop on those companies, then we're leading the market and not following it. And that's my objective. That's my goal. Which leads me to the last big thing. This too is one of the biggest improvements, right? The investments that are being talked about, the capital expenditures, are cash, not debt, not stock transfers, not stock deals, cash. Cash investments in other companies. So NVIDIA investing $50 billion or whatever amount of cash in OpenAI is a capital investment, but it's not a debt investment for NVIDIA. And if NVIDIA continues to print earnings the way that they typically have, they'll make that cash back. But that's one of the biggest differences between this and the dot-com era, where the dot-com era was largely debt financing or IPO financed and everything collapsed. Here, again, established companies with established revenue, established profitability. So if things don't happen as quickly, these companies, it's not like NVIDIA is going to go out of business, right? They'll continue to make all of the different chips that they make. So what I see, putting it down into two words, waves, technology waves, right? You'll see AI will go like this, like this, like this, like this, like this. And if you put this down, here's AOL, here's Amazon, here's the iPhone, right? Here's the iPad, just as an example, which launched the app era, the digital app era, right? That's the dot-com era in a wavy time frame that I just drew for you there. AI will follow something similar. It won't be exactly the same. There'll be differences, obviously. But if you look back from 1994 to 2020, that you can spot everything, key time periods where specific things happened that fueled the next wave in technology, in demand, in consumer adoption, in business adoption, et cetera. AI should follow the same path. So for AI2 insiders, coming soon. The last week has been an exciting development week, so I want to share everything with you. Working on this example is this is card view. These are little widgets that will go inside of the AI2 index and inside of the core portfolio dashboard, which I'm finalizing, and even the momentum portfolio dashboard. So you have a better understanding of why am I investing in this particular company. Giving you key details, key metrics. We have a group. I'm working with a couple of different views, sort of a longer view with, consider down here, these are positives and negatives, right? These are what could go right, what could go wrong. What are the key statistics around the company, the metrics that are driving it, and why are we investing in it? Why do we want to own it? And here's another view. This is one that I'm looking at as well. From the index, the AI2 index, what's its growth discount rating? Growth to discount rating. Is it excellent? Is it poor? Is this a company that is growing its earnings faster than the market is valuing? So simple ways to look, and even for an investor, coming up with categories and risk levels, so somebody can say, you know what, I want these types of companies. I want these safe plays with low risk. Or somebody else can say, yep, I'm aggressive. I want these moonshots. So we're working on developing and rolling all of this out in roughly the next 2 weeks. And then for AI2, the core portfolio tracker, all of the numbers, none of the numbers here are legitimate, right? This is just the coding version. So this is the fake version, right? but working on being able to create a value return, how many positions, building an equity curve. We do not want an equity curve that looks like that. We want an equity curve that looks better than that. So a little bit of patience, but I'm almost done. I have most of the data built in, and what I'm working on is in the background. The next major discovery and advancement that I've made in the last week, and this is one that you folks can do on your own. You can do this. I've shown this in the past using Yahoo Finance because it's quick, easy math. It's not nothing complicated. But what I am now able to do is to get multiple years forward in EPS estimates from 4 different sources. And that allows me to use everything from high, low, median, average to build forward EPS estimates for different companies. We're looking at Broadcom, Avgo right now, and then use those estimates to look at this PE ratio forward. And these are the types of companies that I'm looking for, excuse me. And this underscores why I keep complaining about AI is not in a bubble. For the current fiscal year 2025, Avgo trading at 37 times forward earnings, sure, maybe a little high, but it's not historically out of whack with norms for stocks in the NASDAQ 100, excuse me. For next year, their forward earnings is 28 PE. That's getting pretty close between here and here. That you're looking at S&P level stocks, right? This is consistent where S&P 500 stocks are trading 22 to 28 times forward earnings. By the time you get over here to 2028, that's recession level. 18, I mean, so if you're a long-term investor and you find a stock which has a PE ratio that's going down like this, it means that their earnings expectations are growing at a multiple faster than Wall Street can value the stock. That's a long-term investment. This is a long-term investment because Broadcom's not going to stay at 18 times forward earnings. And if their earnings are growing, which they are year after year after year, and we can see their EPS growth, which is higher than the average company, may not be the highest on the market, but the average company is roughly 10%, 7.5% to 10%. That's the average. Well, this is many times that. So there's a justification on the earnings side, on the valuation side, on the growth side. And what I can now do, because I can look into the future, and as we end 2025, I'll be able to now have 2029 on the back end of this. So I will almost have 4 full years of earnings data to be operating from. And what that allows me to do at the bottom is project price growth with greater confidence because I'm using multiple sources for my earnings estimates, all of them legitimate sources. And the way that I'm doing that, you can sort of see the methodology. Well, you can't see the methodology here is weighting based on the next 4 quarters because a company may be crossing over between a fiscal year and a non-fiscal and a calendar year. So I'm using 4 quarters, first fiscal year out, second, third fiscal year out, and I can even go out to a 4th fiscal year if I get those or if I have those. If not, I just roll the percentages back up the line a little bit. So for Avgo right now, it gives me a weighted PE today of 42. It's a little higher than where they are, but looking between these numbers here, the trailing 12 months and next 4 quarters, et cetera, I'm still in between those. But that allows me then to project out the price growth. So really, Avgo for the year should have been trading down here, which it largely was. Going into next year, it should be trading here. It's pretty close to that right now. And then we know from our expectations here that there is future growth in the stock. So this is one of the major projects that I've been working on to build into the AI2 index. I'm going to roll this out across all of the stocks in the index, not all at once, but over the next several weeks. So you don't have to necessarily rush out and say, well, I want the stock with the most right? This is 72% over 3 years and 2 months. That's high. Can you do better? Sure. You might get the lucky stock that goes up, a, 200, 300, 400%, but you don't have to. If you have a portfolio that's performing in this range between 46 and 72% in a 2 to 3 year timeline, your portfolio is growing at a ridiculous rate. I, I would have the math to prove that, but I didn't build that in. It doesn't matter today. So the other thing that I'm working on adding in is a visual of that price growth. Again, it's projection, not guaranteed, but this gives us a sense of what is the price supposed to do. What are the valuations that are driving that price? So as the weighted PE rises, as the price rises, what's the impact as to the weighted price to earnings ratio? So this is helping me now to identify when I want to build the core portfolio or make recommendations for stocks for the long term. I have a stronger fundamental case for making that recommendation for AI2 insiders and future AI2 members. Moving to the momentum portfolio, I'm a little over on time, but we have start on the far left side here, portfolio overview. October 6th, we started with $10,000 in capital, current value 11,659. So it's just under a 16.5% return in 6 weeks. We have realized P&L of 668, unrealized gains of 990. Hopefully we can score these, capture these in the next 1 to 2 weeks. On the open position sides, 6 open positions, 3 in the red. So Shopify is the worst one, but because we don't own a lot of shares, it's the impact of these 3 stocks together is about $110. About 110%, $110 combined. So it's not a huge negative. If we shut those 3 stocks down, I don't think we'll miss them. But I'm going to give them another day and see what kind of follow through we get in with tomorrow's market action. The 6 stocks that are remaining, giving us a pretty solid gain. We have 2 stocks that are approaching their targets in Western Digital and Coherent. So make sure you check the dashboard tonight or tomorrow morning. And I have not changed the target exit price, but make sure you have that sell limit in. If you had your sell limit in on Lumentum today, then you should have exited somewhere between 264, 267, depending on the time that you might have exited or executed. You could have gotten out as much as anywhere from 270 to 273 before the stock pulled back in the post-lunch hour. But that was we'll look at it on the next page. So we now have 5 total closed positions, 4 winners, 1 loser. That 1 loser lost $5.60. So the win rate, who cares? We made 668 or nearly 18% on the closed positions. And looking at, I'm starting to build an equity curve. It's a little goofy because it's only covering a period from October 5th to November 10th. But it's moving in the right direction for now. But overall, our closed positions down here, Oracle less than 2%, Big Bear, we lost $5. Lumentum, which we closed today for 37%. Rocket Lab, Navitas Semiconductor, which we closed back in early October, 18 and 24%. So 3 double-digit wins there. We have a couple of double-digit wins on the board right now, and we'll look to take those off. I will be watching. And Navitas was up 20% today. Navitas did a round trip. So here was the entry price, $8.04. So Navitas went from $8 to $17, back to $8. So it did a round trip. So for all my angst over exiting with just the 25% gain, I'm glad that I didn't take the round trip down. So that just they happen to be up 20% today, back over $9 a share. We might look to take another shot at that one. Lumentum, I'll look for a pullback and potentially re-enter that because beat earnings, beat revenue, say it with me, raised forward guidance. So even though we set a target price, rather than moving the target, I opted to take the gain and we'll look to re-enter that stock potentially with more capital at play since we know it's a good stock to own now. We have more confidence trading that stock. We'll look to add that one hopefully maybe in December, maybe in January, whenever we can get a reasonable entry price. But overall, this total capital differs from what I shared earlier because this is total capital from open and closed trades combined. So we've had a total of 13,000 invested. I took the snapshot earlier in the day. I think this finished out around the 40 level, so 1640, give or take 20 bucks, not that big of a deal. But our overall return is pretty solid for 5 weeks, so I'm excited about that. Uh, so because of the the additions coming for AI2 across the board, the research that I keep doing to justify the thesis. I put everybody in one webinar this week. I won't do it all of the time, but I didn't want to do this webinar twice. So I appreciate everybody holding out till 4 o'clock. And I think that is it. Let me take a quick look and see if we have any questions. I think I had a couple of people on. That doesn't look like it. So all quiet over there. Yeah, Lotus 123. That was, see, I didn't use Lotus 123. That's why I can never remember it. Yeah, so we'll have the recording shortly. No problem. Looks like everything is good. What resources do you use to help you answer the question, am I wrong? Great question. So number one, I do wide searching on financial and news media. And then I use, frankly, I use artificial intelligence to collate all of that information so that I can read it faster. I use earnings transcripts from companies that have just reported earnings that are in the artificial intelligence sector. That's why I've pulled some of those quotes out over the last several weeks, a couple of times. So I'm reading what CEOs or CFOs are saying about either deploying, generating revenue, or making investments in artificial intelligence. There are also, I also follow Tom Essay at the Sevens Report, who is regularly reporting on what he calls AI enthusiasm, excuse me, as it relates to driving the market higher this year. So it's a broad base of sources in that sense, and I need that because, as frankly, as an English major, more sources is always better. So I probably overdo it. I listen to people like Kathy Wood. I listen to the contrarian hedge fund investors when they're doing events or interviews so that I can balance out as best as possible what they're saying and then collate that down to what does the future hold. So that's a really great question. Thanks for asking that one. Yeah, they are all defunct now. So I haven't come across a company called Boosted. Um, are they a car theft company? Because that's or do they jumpstart people's cars on cold mornings? It's a great name for a company. No, I haven't come across them, but if you have anything on them, just drop me a note. I'll take a look at them at some point. Absolutely. So, all right, that's it. Let me